Hi students, welcome to the video on Management Accounting Working Capital Assessments. In the previous video, we have discussed the requirement of working capital. So, working capital means current assets minus current liability. If bank borrowing is given, we have to calculate working capital gap. That means current assets minus current liability excluding bank borrowing. So after calculating the requirement of capital based on the production cycle, that is operating cycle. So operating cycle includes procurement of raw material and ends with collection of receivables. So while thinking about operating cycle, suppose the business invests cash in the business first. Suppose in business is in short of cash, then it can purchase the goods on credit basis from suppliers. So first purchase the goods on credit basis to the supplier, or if the business is having cash, then utilize the cash. Then procurement of raw material starts. That is purchase or procurement of raw material. Then after purchase of raw material, production process starts. Production process means first work in progress. Generally, we consider 50% completion as work in progress. So this is under production process. Then after work in progress, the next stage is finished stock. It is finished stock. Then last stage is sell. Sell may be on cash basis and credit basis. Very small amount or small portion of business is in terms of cash, major portion in terms of credits. So that is receivables, debtors plus bills receivable. Then the debtor or bills receivable, if we are selling goods to our customer, then simultaneously we may send one stamp paper where we write pay Mr. X, means myself, or my order, rupees suppose 1 lakh, rupees 1 lakh. After 3 months, so we have given suppose the debtor period 3 months, or after 1 month and value receipts. That means the customer will accept the bill. If the customer agrees, within the stamp paper or below the stamp paper, within 2 parallel transfers line, the drawee or the customer will write accepted. Then put his signature. Then after the customer accepted the bill and returned it to us, then for business it is bills receivable, for customer it is bills payable. When the business receives bills from the customer or debtor, the business is having 3 alternatives. The business may keep the bill till the date of maturity. On maturity date, after 1 month or 2 months, present the bill to the drawee and receive the payment. Second, if business is in need of cash, it may approach the banker for discount of bill at the bank. For that, banker will give some month's interest as charges, bank charges, and credit the residual amount in the account of the company or the business. Then third is, suppose business is purchasing goods from its supplier on credit basis, the bill will be endorsed in favor of that pay. That is the supplier. Then on the due date, the bill is made by the drawing. So ultimately, there will be relation of cash. So business starts with investment cash for procurement raw material. If it is a manufacturing concern, then there is procurement raw material. If it is trading concern, there is procurement of finished goods. Then, if in manufacturing concern, first we will procure the raw material. Suppose for purchasing raw material, the business needs 30 days. Then in work in progress, suppose 10 days. Then finished stock, suppose 20 days. And relation of debt, suppose from debtor, it takes 30 days. And the business take the opportunity to purchase on credit basis from supplier for repayment after a period of 30 days. That is 30 days. So total operation cycle, that is period, is operation period is equal to procurement of raw material, that is 30 days, plus conversion or process time, that is first is in work in progress 10 days, in finished goods 30 days, then average time of holding the finished goods in the 30 days, then less time allowed by the supplier 30 days. So total is 90 days minus 30 days, so it is 60 days. So 60 days is the operating cycle. That means it starts for investment of cash or procurement of raw material, ends with the relation of debt or receivables. So during a period of suppose 1 year, approximately suppose you take 360 days divided by 60, so it is 6 times. That means during the year there will be rotation of 6 times. Suppose in the business the sales is suppose during the year, that is annual sales. Suppose annual sales is 30 lakhs. And operating expenses, suppose operating or annual operating expenses, that is annual operating expenses, suppose 24 lakh. So business needs 24 lakhs during the year for running of the business. So that 24 lakhs banker will finance 24 lakhs divided by number of times the production cycle, that is 6 times. So 24 lakh divided by 6. So 4 lakh will be the working capital limit. Because annual sales is 30 lakhs, annual operating expense 24 lakhs, during the year 24 lakhs. So it needs 60 days, 2 months. The cash will be converted to cash, it needs 2 months. So for 2 months the need is 4 lakh, which will be financed by the bank according to the operating cycle method. This is operating cycle method we discussed in the previous class or previous video. In this video, we will discuss drawing power method. That means in the previous video we told there are 5 methods of working capital assessment. First, operating cycle method, that I discussed now. Then drawing power method. Third is turnover method. Fourth is maximum permissible bank finance method. In this method there are 2 types, 1 and 2. Then cash budget method. So what is drawing power method? Amount that a customer can withdraw every month or quarter from cash credit account based on stock, book dates and creditor statement submitted by the borrower. So when the borrower will submit the stock, suppose stock 50 lakhs borrower submitted, then will give or will keep margin 25%. Margin 25%. 25% means 12.5 lakh. So net is 37.5 lakh. This is our net stock plus book debt. Suppose book debt is 10 lakhs. In book debt, generally margin is 25% to suppose 40%. So margin suppose 30%. Means we will deduct 3 lakhs. So it is 7 lakh. It is 7 lakh, it is 37.5 lakh. That is stock plus book debt. So stock is 37.5 lakh. Then book debt is 7 lakh. So total is 44.5 lakh. Then creditor. So for creditor will deduct minus creditor. Suppose creditor is 20 lakhs. 20 lakh. Then margin less margin. Suppose margin is 25%. 25% means 1 by 4, 5 lakh. So creditor is 15 lakh. That 15 lakh will deduct here. So net stock minus margin 25% is 37.5 lakh. Then book debt minus margin is 7 lakh. So total is 44.5 lakh minus creditors. It is 15 lakhs. So the drawing limit is 29.5 lakh. So you remember, drawing limit is separate from the limit or cash credit limit of any company or organization. In the cash credit, suppose the loan is sanctioned under turnover method. Under turnover method, 20% of sales. 20% of sales, that is generally projected sales also, sanctioned. Suppose it is 200 lakhs. Turnover is suppose 200 lakh. So 20% of sales means 40 lakhs. That is 40 lakh is the limit of a borrower. But based on his stock, book debt and creditor statement, the drawing limit marked is 29.5 lakh. That the banker has to mark in the CBS. That means for the month or quarter, and when the stock, book debt and creditor statements of the borrower is received at the bank, the banker will mark this is his limit, 29.5 lakh. Even though he has been sanctioned 40 lakh working capital limit based on suppose turnover method. So nowadays for Mudra loan, in case of Mudra MSME Act, up to 50,000 is up to 50 lakhs. One range is up to 50,000. Or 0.5 lakh. Then up to 5 lakhs. Then up to 10 lakh. This is Ishur. Then Tarun. So up to 10 lakh, no security is needed. Up to 10 lakh, no security is needed. Then if the bank gives loan more than 10 lakh, then it can be covered under Credit Guarantee Fund Transfer Scheme, that is CGT MSN. CGT MSE. So up to 2 crores, the loan is covered under CGT MSE. Now, recently under hybrid system, partly the banker can receive the collateral and partly banker can cover the loan under CGT MSE. Thank you for watching the video. In the next video, we will focus on turnover method and maximum permissible finance